What if the government owes you thousands of pounds right now, and nobody is ever going to tell you? Somewhere in a filing system in London, there could be a letter with your name on it that simply never gets sent. Stick with me for the next few minutes, because by the end of this video, you'll know exactly which 5 payments you might be missing and exactly what to say on the phone to get them. Before we go further, if you find even 1 pound of this useful, hit like right now. It costs nothing, takes 1 second, and it tells me to keep making videos like this instead of giving up and going back to cat videos. Subscribe to and turn on notifications because the rules around these payments change every single tax year, and missing an update can cost you real money. Let's talk about why this happens in the first place. The British benefit system is not designed to chase you down with money. It is designed to wait. If you don't apply, you don't get paid. That sounds obvious, but it has a brutal consequence. Millions of pounds sit unclaimed every single year, not because people don't qualify, but because nobody told them they qualified. Pensioners are hit hardest because so many of these payments were created decades apart by different departments with different rules, different forms, and different phone numbers. There is no single office that looks at your whole life and says, here's everything you're owed. That job falls on you. Or more honestly, it falls on whoever is willing to sit on hold for 20 minutes and ask the right questions. That's what this video is, a list of the right questions. We're going to go through 5 separate payments. Some of these you may have heard whispers about, others will be completely new to you. One of them alone has already paid out more than £800 million to pensioners who had no idea they were owed anything until a letter showed up out of the blue, and that's just the cases the system has caught so far. Thousands more are still sitting in the queue, untouched because nobody picked up the phone. We'll start with the biggest one. For years, something was quietly broken inside the way the state pension gets calculated, not for everyone. But for specific groups of people, the system simply failed to apply the correct uplift to their pension, and once a government computer makes that mistake, it doesn't fix itself. It just keeps paying the wrong amount, week after week, year after year, until someone manually corrects the record. In 2021, this got serious enough that the Department for Work and Pensions launched a formal review to go back through old pension records and find the people who had been shortchanged. By early 2025, they had already identified well over 100,000 pensioners affected and paid back close to £805 million combined. Read that again. Over 100,000 people were quietly receiving less money than they were legally entitled to, in some cases for over a decade, and most of them never noticed, because how would you? Your pension just looks like your pension. Nobody warns you it's wrong. So who actually falls into this category? The first group is married women whose husbands retired before 2008. Under the old rules, many of these women were entitled to have their pension boosted to 60% of their husband's pension amount, but that uplift was never automatic. It had to be triggered, and in a huge number of cases, it simply wasn't. The average back payment for women in this group runs into the thousands of pounds. The second group is widows. When a husband or wife dies, the surviving spouse's pension is supposed to be reassessed, often using a combination of both partners' contribution records. That reassessment is supposed to happen the moment a death is registered, but the system depends on that information being correctly passed between departments, and sometimes it just isn't. Widows in this category have seen average back payments well into 5 figures when everything is added up. The third group is pensioners over the age of 80, who should have received an automatic top-up to bring their pension up to a minimum level, sometimes called the Category D uplift. Again, automatic on paper, not always automatic in practice. And the fourth group is one of the most heartbreaking because it affects women who did everything right. If you were at home raising children in the 70s, 80s, or 90s, and you claimed child benefit during that time, you were supposed to receive what's called Home Responsibilities Protection, national insurance credits for the years you weren't working because you were raising your family. But the old child benefit forms in many of those years didn't ask for a national insurance number. Without that number, the credit never linked properly to the mother's record. Years later, when she reaches pension age, those credits are simply missing, and her pension comes out lower than it should be. One documented case from this exact category resulted in a single back payment of over £30,000. One phone call, one letter that should have arrived years earlier, £30,000. If you think you might fall into any of these 4 categories, married before 2008, widowed, over 80, or a mother who claimed child benefit decades ago, this is the call to make. Ring the state pension review line and simply ask them to check your record against the known underpayment categories. Say it plainly. I'd like you to review my state pension because I believe I may fall into one of the underpayment groups you've identified. That sentence alone is often enough to get the wheels turning. For the home responsibilities protection issue specifically, there's a separate form, CF 411, handled through HMRC's National Insurance Helpline rather than the pension line, so if that's your situation, ask for that form by name. This single payment category has reshaped retirements for tens of thousands of British families, and the department isn't going to chase down every case. They've found the obvious ones. The rest are waiting for someone to ask. Now let's talk about the payment that affects the most people and gets claimed the least. There are roughly 850,000 pensioner households across the UK who qualify for pension credit and simply aren't claiming it, not because they're ineligible, because they don't know, or because they assume wrongly that they don't qualify. The average loss per household sits around £4,300 a year, not a one-off, every year, for as long as you're entitled. Pension credit works as a top-up. It brings your weekly income up to a guaranteed minimum floor. For the current tax year, that floor is set at £218 and change for a single pensioner and around £363 for a couple. If your total weekly income from every source, your state pension, any private pension, savings interest, all of it combined, falls under that line, you are very likely entitled to a top-up that closes the gap. Here's where most people talk themselves out of applying before they even start. They assume owning their home disqualifies them. It doesn't. Owning your home outright has zero effect on this calculation. They assume having savings disqualifies them. It mostly doesn't either. The first £10,000 in savings is completely ignored. Above that, it only counts as a small notional weekly income, which might shrink your top-up slightly, but in the vast majority of cases, it does not knock you out of eligibility entirely. Let's make this real with an example. Picture a widow living alone in a house she owns outright, with no mortgage. Her state pension comes to around £215 a week. She also gets a tiny private pension from a job decades ago, about £15 a week. Add it together, and her income sits at £230 a week, just under that £238 threshold. If she applies for pension credit, she's entitled to a top-up of roughly £8 a week. On its own, that sounds almost too small to bother with, a little over £400 a year. Hardly life-changing. But here's the part almost nobody understands, and it's the most important sentence in this entire section. Pension credit isn't really one payment, it's a key. The moment you're approved for it, a row of other benefits unlock automatically. Her television license becomes completely free, saving around £159 a year. Her council tax bill gets slashed, sometimes by close to £2,000 a year, depending on her council and property band. Her energy bill drops through the warm home discount, saving another £150. If she needs dental work, it's free under the NHS, saving hundreds more in a single year. Add it all up, and that small £8 weekly top-up just unlocked over £3,000 a year in total value. This is why pension credit is the single most underclaimed benefit in the entire system. It looks small from the outside. It is not small once you're standing inside it. If there's even a chance you're under that income threshold, call the pension credit line and ask them to run the numbers for you. It's a free call, it takes about 20 minutes, and the operator will walk you through your income, your savings, and your housing situation right there on the phone. There's no harm in checking. The only outcome of being wrong is finding out you don't qualify. The outcome of being right is thousands of pounds a year for the rest of your life. If you're starting to realize you might be one of these people, do me a favor. Drop a comment with just the word checking. It helps me understand how many people watching this are about to make that call, and it tells me which payment to dig deeper into next time. Let's keep going. Now payment number 3, and this is one almost nobody talks about, which is strange because it might be the simplest claim on this entire list. It's called Attendance Allowance, and it's built differently from almost every other benefit in this country. Most benefits ask about your income. Most benefits ask about your savings. This one doesn't ask either question at all. Attendance allowance is a tax-free weekly payment for anyone of state pension age who has a physical or mental condition severe enough that they need help with personal care or need supervision to stay safe day to day. The current rate split into two tiers. The lower rate pays just under £77 a week. The higher rate pays close to £115 a week. Over a full year, the higher rate adds up to almost £6,000, paid straight into your bank account every 4 weeks, on top of everything else you already receive. Read that last part again, because it's the part people miss. On top of. This isn't a replacement for your state pension or your private pension. It stacks. You could have a six-figure sum sitting in savings, own your home outright, and have a generous private pension, and none of that disqualifies you. The only question that matters is whether your condition makes daily life harder and whether you need help because of it. And the list of conditions that qualify is much broader than most people assume. Arthritis severe enough to make washing and dressing difficult. Heart conditions that limit how far you can walk or what you can manage around the house. Any form of dementia where someone needs supervision to stay safe. Vision problems. Recovery after a stroke. Hearing loss. A history of falls. Even anxiety or depression if it's serious enough that someone needs to check in regularly to make sure you're all right. The name of the diagnosis matters far less than the honest, practical answer to one question: do you need help every day to manage safely? Let's put a real face on this. Imagine a man in his late 70s, living with his wife, who was diagnosed with Parkinson's disease 3 years ago. He can still walk through the house. He can still make it to the kitchen on his own most days. But every morning his wife helps him wash and get dressed, and she watches him closely on the stairs because he's fallen before. He never applied for attendance allowance because somewhere along the way he convinced himself his savings would disqualify him. His wife assumed the form would be too complicated to bother with. Both assumptions were wrong. If he qualifies for the higher rate, those 3 years of not claiming represent a loss of around £17,000. Money that simply evaporated, not because he wasn't entitled to it, but because nobody told him the rules. The form is called AA1, and you can request it by ringing the Attendance Allowance helpline directly or download it from the official government site. It's a long form, and that's the one honest downside here. It takes patience to fill in properly, because the answers you give shape which rate you're awarded. The gap between the lower and higher rate works out to roughly £2,000 a year for the exact same person, depending purely on how clearly the form explains their daily needs. If filling it in alone feels overwhelming, Age UK offers a free service specifically to help pensioners complete this form properly, and it's worth using because a poorly answered form can mean years of receiving less than you actually deserve. One important thing to know going in: this benefit usually can't be backdated beyond the date you apply, so whatever time has already passed is unfortunately gone. But that's exactly the argument for applying today rather than next month. Every week you wait is a week of payment you'll never get back. If you have a parent, an aunt, an older neighbor, anyone whose health has quietly declined over the last few years, and they're not currently receiving this, this is the phone call to make for them this week, not someday. We're a little over halfway through this list, and honestly, this next one might be the one that changes the most lives because it's tied to something deeply personal. Picture this: somewhere in your family, or a family you know, someone was diagnosed with dementia or Parkinson's, or had a stroke that left lasting cognitive damage. The day that diagnosis landed, the conversation in that doctor's office was about medication, about care, about what comes next for that person's health and safety. Nobody in that room was thinking about council tax. Why would they be? But here's what almost nobody tells families in that moment: that diagnosis may have just made them eligible for one of the largest council tax discounts in the entire system, and most families never hear about it until years, sometimes a decade after the diagnosis was made. It's called the severely mentally impaired exemption, and the logic behind it is simple. If a person living in a property has been diagnosed by a doctor with a condition that severely affects their mental functioning, that person is treated for council tax purposes only, as if they're not living there at all. Conditions that typically qualify include any form of dementia, Alzheimer's disease, Parkinson's disease where there's cognitive impact, severe learning disabilities, and stroke where cognitive function was affected. The financial impact depends on who else lives in the home. If the diagnosed person lives completely alone, their council tax bill can drop to zero. If they live with exactly one other adult, that bill drops by 25% because the remaining person in the household is now treated as a single occupant under the rules. And here's the detail that turns this into one of the most valuable calls on this entire list. In most councils, this discount can be backdated all the way to the original date of diagnosis, not the date you apply, the date the doctor confirmed it. Think about what that means for a family that's been quietly paying full council tax for 5 years since a parent's dementia diagnosis. 5 years of backdated reduction, sometimes reaching into the zero tax category, can produce a refund running into the tens of thousands of pounds. A single letter from a GP confirming the diagnosis and the date it was made, combined with a short application form from the local council, is often all it takes to unlock it. So why does almost nobody know this exists? Because there's a gap in the system nobody is responsible for closing. Doctors focus on medicine, families focus on care. Councils only act when someone applies. There is no automatic link between a medical diagnosis and a council tax review. The entitlement simply sits there untouched on a GP's file while the family upstairs keeps paying the full bill every single month. If someone in your household, or someone you care for, has been diagnosed with any of these conditions, and the council tax has continued at full price since that diagnosis, this single call could be worth more than every other payment on this list combined. Ask your GP for a short letter confirming the diagnosis and the date, then contact your council's council tax department and ask specifically for the severely mentally impaired exemption application. It's usually no more than 2 pages long. Take a breath with me for a second. We've covered 4 payments now, and if even one of them applies to you or someone you love, this video has already done its job. But before we get to the 5th one, I want to ask you something directly. If this is genuinely new information to you, if you didn't know about even one of these, type the number of the payment that surprised you most in the comments. 1, 2, 3, or 4. I read these, and it helps me know exactly which one to expand into its own full video. And if you haven't already, this is the moment to subscribe, because next week's video goes even deeper into one of these categories specifically. Now the last one. It's the smallest amount on this entire list, but it might be the easiest claim you'll ever make in your life, and it's the one that pays out fastest. It's called Marriage Allowance, and here's the simple idea behind it. If one spouse doesn't earn enough to use their full personal tax allowance, they can transfer part of that unused allowance to their husband, wife, or civil partner. The effect is straightforward. It reduces the higher earning spouse's tax bill by up to £252 a year. And you're not limited to claiming it once. You can claim it every single tax year, for as long as your circumstances qualify, and you can backdate the claim up to 4 years. If you've quietly been entitled to this for the last 4 years and never claimed it, that backdated lump sum comes to roughly £1,000, paid as a single payment straight into the higher earner's bank account. The eligibility rules are genuinely simple, simpler than almost anything else on this list. You need to be married or in a civil partnership. One partner's income needs to sit below the personal allowance threshold, which is £12,570. The other partner needs to be a basic rate taxpayer, earning under £50,270. That's the whole test. This describes an enormous number of retired couples in this country. One spouse living on the state pension alone, the other with a state pension plus a modest private pension on top. If that's your household, marriage allowance almost certainly applies, and it costs you nothing to claim it. £252 lands in your account every year, with no ongoing paperwork once it's set up. There's one detail that trips people up constantly, so listen closely. The claim has to be made by the lower earning spouse, not the higher earner. That's not a typo, and it's not optional. It's built into the rules because the lower earner is the one giving up part of their personal allowance, so HMRC needs their direct consent on file. If your spouse is in their 70s and not comfortable navigating an online form, that's not a problem. There's a phone line specifically for this, and an HMRC operator will take the entire claim verbally over the phone instead. The online version takes about 10 minutes if you'd rather do it that way. And you'll need both national insurance numbers plus some form of identification, like a passport or driving license. Processing typically takes a few weeks, and any backdated refund usually arrives within about 2 months of approval. It's the smallest figure on this list, but it's also the fastest, simplest, lowest effort win available to almost every retired couple in Britain. There's genuinely no reason not to check. So let's bring this all together, because by now you have 5 separate calls in your hands, and I want to be honest with you about something. None of these 5 payments overlap. None of them cancel each other out. A single household could realistically be entitled to all 5 at once: a corrected state pension, a pension credit top-up, attendance allowance, a council tax exemption, and marriage allowance, all running side by side every single year for the rest of that person's retirement. Think about what that actually means. We're not talking about a one-off windfall here. We're talking about a different financial reality for the rest of someone's life, a wider gap between what they have and what they need to worry about. The difference between turning the heating down in winter and not having to think about it at all. Between dreading a hospital bill and being able to absorb it without panic. Money like this doesn't just sit in a bank account. It changes how safe a person feels every single day. And here's the part that should genuinely bother you. None of this requires new legislation. None of it requires a political fight or a campaign or anyone marching on Parliament. Every single payment on this list already exists, already passed into law, already sitting in a government budget waiting to be claimed. The only thing standing between a pensioner and this money is a phone call that hasn't happened yet. So here's what I want you to do right now before you close this video. Don't just nod along and think, interesting, I'll look into that sometime. Sometime rarely comes. Pick one payment from this list, just one, and write its name down on a piece of paper right now, today, tomorrow morning, before you do anything else. Make that one call, just one. You don't need to tackle all 5 in a single afternoon. You need to make one phone call that you weren't planning to make yesterday. And if you're watching this and thinking of your own mother, your father, a grandparent, an elderly neighbor who lives alone and might not see this video themselves, send it to them right now. Not later, not when you remember. Right now, while it's open in front of you. Somewhere in that conversation might be 5 figures they never knew they were owed, sitting quietly in a system that was never going to tell them on its own. I'm going to keep digging into these stories every single week, because the truth is, this system was never built to make claiming easy. It was built to wait. And the only way to beat a system built on waiting is to stop waiting yourself. If this video helped you, even a little, hit like before you go, and subscribe so you don't miss what's coming next. There's more money out there that nobody's telling you about, and I'll see you in the next one.